Our first speaker this afternoon is Dan Basse, the founder and president of AgResource Company, a domestic and international agricultural research firm located in Chicago. AgResource forecasts domestic and world agricultural price trends and provides information and research to farmers, elevators, and commodity processors across the crop and protein industries. Dan is an economist who has been in the commodity business since 1979 and has been a highlight of the Feeding Quality Forum for many years. We're thrilled to have him back to kick off this year's program and look forward to the global market overview he has to share with us today. Dan, I'll turn it over to you.
Well, thank you, Kara. And as she suggested, I'm sorry not to be with you this year. It's been a little different here in Chicago. We're not even going down to our offices at this point, as everybody is still concerned about our health and the disease. So I hope you're all staying safe. I hope that this presentation is of value to you. I know it will be as prior years, but I really wanted to step back and take a high-level look at what the world is looking at in terms of COVID, how it's affecting the U.S. economy, and more importantly, how it's affecting agriculture. Of course, all of us have been running back and forth to our mailboxes from time to time, waiting for that check to come from the U.S. government. It's been more than normal. And so as we look at what's been going on in the agricultural trade, I really want to highlight where we are globally, what kind of volatility the markets can be offering us, and where we can think about profit opportunities going forward. So let's just jump right into it. As we look at the COVID-19, it's been a big health threat. I mean, I don't think any of us a year ago would have thought that we'd be sitting at home watching a computer screen while the economy basically is struggling. You know, we've lost over 3 million businesses, small businesses, since the start of this health scare. We're concerned that that may rise or grow to something like 6 or 8 million businesses by the end of the year. This is small businesses now, but it's the heart of the U.S., of course, agricultural and economic outlook of the United States. Now, the big question must come in is, when is this going to be over? Because we'd all like to get back to some kind of normality. And we only see that happening with some kind of health aid, if I will, something like a vaccine or very strong therapeutic. We think that that is probably at this point, from our best research, is we're looking at probably Q1, the first quarter of next year, that a vaccine will be available. And we think at that point, it will take 6 to 9 months if it's a 2-step vaccine. But then I'm saying getting 1 shot and then a booster 30 days later. So we've got some time to go through this. If you really want to think of when the U.S. economy will get back on track, we think it's about a year from now, maybe August of 21. So we've got some time to go through this before we're all back into it. Let me just get to the other one here. I'm sorry. The U.S. food service industry is still struggling. We're only back to approximately 40% of normal here in Chicago, or a lot of places where we consult with. Restaurants are still basically outdoors. They're spacing, but as we get the cold weather coming in, a lot of these restaurants will be forced to shut down again. And so the food service industry has been very important to the U.S. cattle industry. We're still believing anyway that it will struggle until we get to next spring. So I want all of you to plan about that. And we think about the U.S. food service industry, you know, just last year that 51% of Americans spent food dollars more outside the home than inside the home. So it's a big change to have that industry crippled as it is due to health concerns. We've got, of course, during this health scare, massive debt building up. In the United States, we're now approaching $26.8 trillion of debt. World debt from a government basis is now over 59 trillion. These are debt levels never seen before. And so as we go forward, we're going to think a lot about these debt levels. What does it mean to the recovery? What does it mean to inflation? Today, there's no evidence that core inflation is much above 2%, but I would imagine as we go forward, there will be shortages that produce a more inflationary tailwind than what we've been seeing before. Now, the U.S. and China reached a trade one agreement back in January 15th. They just had a meeting last night in which they talked about their progress. Both parties seem to believe that we are headed in the right direction. The U.S., of course, is more actively selling corn, soybeans, and meat products to China. The month of July, China imported a record amount of pork from all sectors. But the president is not giving us warm indications that a phase 2 or phase 3 is likely. And so I worry a little bit about this trade agreement. I worry that someday either president, whether it be President Xi of China or President Trump in the United States, will strike a pen and this may be over with. It's a political risk that we've got to be concerned with. The president on Sunday indicated that, you know, we could maybe in the United States, if he's reelected, get used to a world without China. That would probably not be good for U.S. agriculture. And so it really proves in my mind as an economist that these tariffs are easy to put in place, but they're very difficult to remove. If we look back in history to the 1940s or 30s, it really took a calamity to get these tariffs removed. I worry a little bit that this is going to be the case forthcoming. Now, the US dollar has been weakening against the euro, but as we look at other world currencies around the world, the Brazilian real, Argentinian peso, maybe the Russian ruble or hryvnia out of Ukraine, they've all been, of course, weakening versus the dollar. So although the euro has kind of stood up along with the Japanese yuan here as being somewhat of a stable bastion of opportunity, it's not something that's worldwide. And so the real today at 5.6 to 1 indicates to us anyway that Brazil is going to be a very formidable foe in the world grain and livestock markets for a long period to come. Now, our general view is that because of productivity gains, U.S. feed prices will stay relatively depressed. Now, corn market today was up 10 cents. We are going through this late season dryness. We did have these straight line winds in Iowa. This is giving the market some lift as we see it right now. But we think that this lift will be over with as the rains are projected to fall sometime next week. I'm kind of looking for a high in the corn, soybean, and wheat markets in the week ahead. This, as a cattleman, should mean that we should see relaxation in price. But maybe as we get into that fall harvest and basis gets relatively weak, that would be your opportunity to maybe look at forward coverage. Our estimate is that December corn futures will peak somewhere between 360 and 370 a bushel. Today, the U.S. cattle market is struggling between the uncertainties of politics and, of course, COVID and the record large beef domestic demand that is there. We expect that Q1 cattle prices are probably a little overvalued. We'll talk a little bit about why maybe you should all be considering hedging. Last year when I was doing the programs, we all talked about a bottom in the cattle market and a sizable rally into the Q1. This year it's kind of shifted on that, and we do see placement rates kicking up and giving us more beef supplies down the road. So we are looking at hedging here on further strength. I wish I could be more bullish on the cattle market. You've got February in the $114 area. 115 to 117 looks for us to be an ample place to be hedging off and looking for that opportunity to lock in some margin. Lastly, before I get into graphics as a highlight, I want everybody to understand that never before has this occurred. U.S. farm revenue, net farm revenue this year will be determined by U.S. government payments to about the tune of 45% of every farmer's check. So this has never been seen before. This is really uncharted times. And when we talk about the economies, both here and globally, there is an element of risk in this outlook relative to COVID and what's going on. Now, again, it's hard for me to get overly bullish of U.S. agriculture until I see a significant drop in the U.S. dollar. Maybe that will happen as our debt levels get larger and larger. But here today, the U.S. economy is fragile, and we really need to start getting out that aid again for the next package, that tranche, third tranche, if we're going to keep the U.S. economy on track. But for farmers, again, 40 to 45% of your net revenue coming from the U.S. government is something that I never thought I would see in my career. This is now my 41st year. So let's just move right into it and look at what the global economy is projected to do. This, of course, is from the World Bank and IMF. Notice that we're looking, and we did see a downward revision in June of 5% global GDP rates. Now, not every country will have a negative GDP, but the vast majority of them are looking at declines between 5 and 10%. Now, everybody is forecasting a big shift upwards in 2021. Everybody's banking on a vaccine or a strong therapeutic. It may happen, but I believe that a lot of these forecasts are overzealous because of the large amounts of debt that are being built up. If you look at global and U.S. debt levels, they are at insane levels. Never before did I think we'd see a U.S. debt level for government of $26.8 trillion and growing. If we do a third tranche, you're looking probably getting close to $29 and $30 billion, depending if you want to do the Trump package or the Democratic package. It's going to be demonstrative. And so these debt levels offer some kind of additional risk, if you will. Now, I don't think government loan rates or interest rates will go up anytime soon. We see them, as the central bank does, as flat for years to come. But these debt levels are something that I believe will be a drag on the US and world economy for many, many years to come. In fact, if you look at going back at GDP levels of the major areas around the world, and you can pick out your favorite region, whether that's, of course, the United States, Latin America, China, India, Sub-Saharan Africa. Again, notice where we were in 99 to 2008. Then we stepped down in 09 to 18 after the Great Recession. We're now believing that those rates are even a little bit too high. And so as we look at 19 to 28, taking it out another decade, you can see like countries like China, India, they're just not going to have the same kind of growth rates that were expected priorly. So over time, we do think India will and China will become the world's first and second largest economies. The US will, of course, sink to number 3 by about 2025 or 2026. So this is a big change of order. But nonetheless, as we look at this, think about constraintment in terms of global growth, US growth, as we think about the years ahead. This is pretty evident as we looked at the GDP rate for the second quarter of this year, and we're estimating where it would be. That was down 32%. And you can see here annually, we're looking for US GDP rates to be down about 9.2%. So again, a big decline. And when I look back in history, this is something that has not occurred unless we go back to the 1930s. A sizable reduction in GDP rates means that interest rates will stay low, but we also will need additional stimulus because until this health problem is settled, there's not likely an ability to see revised growth or more upward mobility in the economy than what we're seeing here today. So what AgResource has done is we kind of said, okay, with that growth rate that we have, when can you as cattlemen be really thinking about the US economy getting back to when it was? So as we go back and we look at the, of course, baseline forecast, we look at previous forecasts and a new upgrade in terms of where we're at, we kind of think it'll be that August 2021 timeframe. So this doesn't mean that we won't see some growth. We're not going to stay down where we were in April, May, and June. We are going to be seeing recoveries. But again, I don't think we're going to get back where we were prior to that until probably a year from now. So if you think about beef demand, if you think about food service, if you think about the restaurant trade, it's going to be a while, I believe, yet before we really get back to that panacea of normality, a therapeutic or a vaccine that get this economy moving again in the right direction. In saying that and looking at the stock market, we all notice that the stock market has been at record highs as liquidity has flowed from the central bank directly into that market, but also Americans are more cautious now. We've seen a big change in savings rates. Now, to have inflation, we need to have more money chasing fewer goods. What we have today is more money. We still have an abundance of goods, but we also have, of course, a lot of people who are not seeing velocity of money increasing. So one of the keys for inflation for me going forward will be to watch that velocity, money that goes into Bob's pocket, to Mary's, to Bill's, to Joe's. How does that all interchange? Are we investing in new plants, new equipment, new opportunities? Until that happens, this economy will continue to have some struggles. And the savings rate today is high, even with an interest rate near zero. Now, in saying where we are here today, one of the keys to agriculture, as I've been speaking to you in these meetings over the last couple of years, has been the value of the US dollar. You can see here that this is a US dollar index chart. We, of course, has a futures market for the dollar. You can see here that the dollar rate is now sitting on a lower trend line. 93.15 or 16 is where we went out today. I would say this is a critical level. Now, the dollar has weakened, but it's weakened primarily against the euro, not the other currencies, as I mentioned before. However, we are seeing the CRB index, which is a collection of 27 commodities, start to show improvement now. So the CRB in black here, notice how the dollar index and the CRB often acts. So we're seeing things like gold and silver and crude oil start to perform better. This may be a bullish omen, if you will, for some of the commodity markets. I'm not sure really for cattle or for the grains, but at least in the metals, industrial metals, and maybe even looking at some of the petroleum products, this is going to be an opportunity here. So again, notice that the dollar is a key for commodities. As the dollar weakens here and we get that debt level close to $30 trillion, that will be an evidence that maybe we can start to see a little more inflation, a little more bounce in some of those 27 commodities that do make up that CRB. One commodity that does follow the CRB relatively close is corn. So if you look at corn, for whatever reason, going back to 1994, there is some similarities between what the CRB does and what the corn market does. So we did see the CRB market bottom in May there. We did see it start to move higher. We think that the corn market has maybe made its seasonal low already back in August. Maybe the corn values can start to do a little better, but the fund mentality is still not shifted to where they're buying of corn. But I want every cattleman to know that there is some risk in feed prices based on the late season dryness, based on Chinese demand, things of that nature, but also based on the broad commodity markets, which are starting to turn around here just a little bit. However, when you look at the CRB versus US dollar index, it's messy. This is a scatter diagram that I've done just to show you that the relationship is far from true. So there can be many, many months in which, although the dollar can weaken, it doesn't transform directly back into commodities. Be aware that this is a longer term duration trend. This is something that extends for years, not for months. Now, there is a correlation. It just isn't going to be something that I believe you can trade upon month in and month out. And you can't say, well, the cattle market's going up because of CRB or the dollar's coming down. Those relationships don't work as closely as we would like. Getting a little bit in here to the US farm and agricultural outlook, you can see here that really in agriculture, we've not had many farms in terms of growth going back all the way to the 1970s. Land and farm has been holding relatively steady. The average farm size has been increasing, but the number of US farmers has not. We're now down to about 1.7% of the US workforce is made up of farmers. And so our political weighting, if you will, heading into election is always high, but we're not going to be the ultimate determinant of who's a Democrat or who's a Republican or how this is all going to sort out. The point here is that new entrance into our business, agriculture, has been far and few between. It's steady as it sits today, but again, remember that the average age of the US farmer is now exceeding 63 years. We need to have new entrants come in and we need to change the dynamics, which I think technologically will happen in coming years. Now, net farm income has been flat. Of course, we've got net farm income that's down about 47% from where we were back in 2012. I don't know of another industry in which farm and income level has fallen that much and stayed at that level for so many years. Notice that production expenses have come down slightly. Gross farm income has also come down. But again, we need to see a new demand driver if we're going to get this all changed around. The last driver, of course, was biofuels, ethanol, and biodiesel. That was a driver, if you will, to higher agricultural products. I don't have that kind of demand driver here today. We in agriculture need to wake up every morning looking for those demand drivers so that we can see if there's a new demand trend that's coming forward. Maybe it's China in terms of buying more US corn or importing more US soybeans or beef or pork. But I'm concerned longer term that without a demand driver, the markets lack a story unless you're going to be looking at a weather abnormality in grains or maybe something that's export related to in the meat markets. So to look at that farm income and then in perspective what government payments have been, this is a chart going back to 1933 that will reflect upon government farm payments. And you can see in this graphic right here that when I plot where we are this year, notice that those farm payments at around $45 or $50 billion are off the chart. Those, of course, reflect the amount of money that we get a third tranche that will be going into farm pockets. So a much, much different farm support system than what we've had before. All of this, of course, related to COVID. My big question is, it's okay, the money is coming this year, but what does a farmer do, of course, if that money stops in a year's forthcoming? That's a big question mark for this election and the upcoming policies of either one of these presidents. However, we look at the, of course, the Purdue CME indicator of how bullish you farmers and how bullish you farm lenders are. You can see here there's been an upturn in the last month. As of July, when China showed up to be buying more of US commodities, we did start to see an increase in terms of your opportunity and your thought process for the agricultural business. This is good. I think this trend will continue. However, again, I don't think we're getting back to where we were back in March for some period of time, probably looking back maybe a year from now, but it's going to be some sideways skating here for a period of time. Yet as we look at COVID, and this really not only goes to the farm community, these are, of course, the worry warts in terms of what to do with the health scare. So Purdue's gone out and asked the farmer, are you very worried, fairly worried, not too worried, not worried at all about COVID-19? These are the responses. Notice that they've changed rather dramatically from March. We are all as a society less worried about COVID today. We are hopeful that, of course, some of the therapeutics that are offered out there can help prevent some deaths. We also understand more about this disease, so that in its own right has helped us out. But I think this is another reason why optimism from the farmer is improving. One of the questions I get a lot of is American consumers, as in Chicago, they see that the CPI related to food has been up 3 to 4% in the last couple of months. And they go, oh my God, my price of poultry or beef or lamb is going up in price, as are a lot of other things. I put this chart together through 18, and so you can see what Americans are paying for food. Roughly 4.8% of their disposable income. We are by far the cheapest in the world. So when someone comes to you and says the price of beef is too high, the price of pork is too high, the price of oatmeal is too high, you can reflect back and say that you're only spending 5% of your disposable income compared to a country like Hungary or Poland or Japan. That's a far, far smaller level than anything going. And then if you go forward and you look at what that increase in CPI for food has meant, notice that really going back to the 1940s when food prices during the world wars moved around a lot, we are not seeing much movement in food prices at all. So we're up a little bit, but it's really not substantially compared to where we've been historically speaking. Now, it's important to understand when you look at the U.S. contribution to agriculture, roughly $1.05 trillion or 5% of our U.S. economy is due to agriculture. But more importantly, look at this shading in blue. It's this food service, eating and drinking places that are the big contributors. I say this is one of the big drivers of U.S. agriculture, the one bull driver that we need if we're going to be coming out of this land of margin disparity. So we need to see the food service industry getting back. When you look at food expenditures, and I've now plotted food at home and food away from home, notice last year was the first year that we spent 51% of our food dollars out of the home. So again, this sector has become more and more important. I believe this trend, if you will, is related to the amount of women that are working outside the home. When, of course, both individuals work, male and female, of course, they tend to go out and have more meals outside the home. We think this is a trend that will persist. So once we get back to normal health, we think the food service industry will come back, but it'll be a process that will probably take 6 to 12 months. Just putting it in more perspective to you, I've gone back and I've tried to look at 97, 2002, 07, and 12, and I put exports, food service, retailers, other wholesalers, government, and all other in terms of wholesale expenditures by type. Now again, retailers are basically your local grocery store. Food service and wholesalers come together to basically give us that opportunity in terms of food service. And so when I put them together, that's the one ingredient we really need in this beef supply chain or in this food supply chain to come back with more vigor. Notice that exports are always important to us, but they're a very small fraction of the money that is being spent in terms of disposable income on food. This is just a graphic giving you the year-over-year change in restaurant traffic. This comes from Open Table, and so you can plot it either globally or United States. But notice that we're still down 60% from where we were a year ago, or maybe said another way, 60% from where we were in the end of February. Restaurants are coming back, but these numbers are probably going to turn down again as cold weather comes up. So again, I don't see any change going forward. Since about the beginning or end of July, we've seen these lines kind of flatten out. If a restaurant owner wanted to open up, they're up and going. A little bit here what's happening in terms of US and China. When you look at China, they've spent about $6.1 billion through the end of June. This is a January-June total. That compares to $5.4 billion last year. Now they have stepped up purchases in July. Remember, trade data is always about 6 to 8 weeks behind. So the Chinese have a lot of additional demand left to come. When I look in terms of US ag trade, we are at one of those unusual positions of not helping out the US deficit. In fact, we've been importing more food in terms of agriculture than we've been exporting. Very different than what we've seen. In fact, this has now happened for 4 consecutive months. We expect, of course, July to be similar. So again, to really get health in the agricultural community, we need to start the export market kicking off a little more robustly, and we need to see high value goods leaving this country to other nations, principally beef, meats, and some of the, of course, DGGs and ethanol products that we now produce. When I go back and look at percentage of first half of 2020 export demand from 19, you know, the big winner has been pork, up 27.7%, but we in the beef industry are down 15.2%. We're below turkey. And so as you think about the beef trade, we need to see our friends in Mexico. We need to see our friends in other countries, South Korea stepping forward with larger demand. Even with China being there for about 1,000 metric tons a week, it's not enough to keep us going. When you look at US beef trade over the last 6 months, I've calculated here January, February, March, April, May, and June. You can see the impact that very high beef prices had in that April-May timeframe and how it hit our beef export markets so hard in the May, June, and likely July timeframe. Now, I am hearing and I believe that beef trade will start to be reinvigorated going forward, but this is the legacy of high prices that were really due to COVID and the problems plants had in terms of processing cattle and getting enough throughput through their processing plants. When I look at US beef trade and you take the USDA forecast for 2020, we think that August estimate is a little too optimistic, relatively speaking. We are on 1 standard deviation below where we were last year, but we think that could come down even further going forward. So as I head into the 4th quarter, I'm concerned about less restaurant demand, less beef trade demand, and growing placements. It's one of the reasons why, as we model out price, we start to see a little bit of diminishment, if you will, in cattle prices. This is a graphic I put together looking at Q4 average cattle price models. You can see that the USDA is forecasting $104 an average for the 4th quarter. The CME, if you look at it, is at 111. Our model is at about 106. And so to me, if you get 4th quarter futures at 112 to 114, it's a logical place to start doing some hedging and locking and taking some risk off the table. If we then go forward to the 1st quarter, because of the greater placements, 1st quarter of 2021, notice that the modeling would show that, you know, USDA is at 105. We're looking at cattle prices somewhere in the range of 112. And as we look at where the market is, if it's at 116 and 118, that's going to be a big opportunity to be pricing cattle. So again, I'm less bullish of cattle looking beyond the 4th quarter into the 1st quarter than I was last year. I think all of you need to be managing risk for the economic reasons I talked about before. A little bit going into the grain markets now. We are seeing grain yields globally that are surpassing expectations. Globally, we're seeing where 2.7% increase in global grain yields compared to, of course, levels of prior decades. Notice when Norman Borlaug was in the Green Revolution back in 1961 to 70, we did get global grain yields increasing 2.8%. This was the Green Revolution. Then as we go forward, we're really looking at improvement of what we call total productivity factor. This is technology that's helping the farmer, of course, get better yields. Again, not reflecting the dryness we've had the last 3 weeks. We thought we were on the process of getting record corn and soybean yields this year. They will still be high, but probably not records anymore. But the world only needs about 1.7% more food to fulfill demographics, expanding populations. And so when you're producing 1% more grain or food on top of that, it does give us excess supply. We did, of course, have the straight line winds, the Dineco, if you will, across Iowa, much of Northwest Illinois. You can see in this graphic here where those winds really were the worst. You can see that from Burlington up to Dubuque, Waterloo, we had wind gusts of 80 to 100 miles an hour. Now, we've been through the area, we've surveyed crops. We believe that wherever corn was standing at 100 miles per hour, you're looking at 80 to 85% yield loss. 80 to 90 miles per hour, it's 45 to 70, depending upon the field. You get down to 60 plus miles per hour on wind, it's 10 or 20%. So in Iowa, we've cut the corn yield estimate by about 2 bushels an acre, which means that we're looking at a crop that's about 160 to 240 million bushels less than what was expected before this windstorm. And then we had the Farm Service Agency program data that came out right after the USDA crop report. It showed 81.1 million acres of corn that was in the program. Notice looking up this chart how different that really was. Notice that in the other years, 83 million acres was the smallest. Now, remembering that USDA was forecasting US farmers to plant about 4 million extra acres of corn this year at 92 million acres. And so this FSA data has really caused some confusion for the industry and for the corn market. We believe that a lot of this, of course, is due to slow certification. Farmers are still certifying their fields today. A lot of these, of course, FSA offices have been very busy getting checks out to you, checks in the mail in terms of COVID assistance. And so their capacity as an office have been stressed. AgResource is hearing as many 60,000 US farms have yet to certify their program acres for FSA. So we think back, the corn market, we can probably say that, well, NASS, or the National Agricultural Statistics Agency, gets its estimates relatively right at the end of June. This is a chart showing you corn and soybean acreage changes to the final. Notice in the red on corn, there may be some years where we find 500,000 acres or 1 million acres. There's some years that we lose 500,000 or 1 million acres. But without a weather problem, we think USDA at 92 million acres has got it about right. I can maybe take a few harvested acreage off of there for Iowa and the straight line winds, but it probably wouldn't be more than 400,000 acres. As I mentioned before, it's been a very dry month across the plains in the western Midwest. This is stress crops. This is causing crop condition ratings to decline in the rally in Chicago. Notice that this was not the finish that farmers really wanted. It's this dryness that will probably take the top end off of yield. Instead of having 181 or 182 bushels an acre, it may be 176 to 179. That's what the corn market's trying to decipher today. As you look at condition ratings here, you could really see that corn condition ratings have started to come down because of this dryness. Maturation is being pressed. So as cattlemen and as consumers of grain, this is something you need to be watching. But notice that on the right, condition ratings are still above the historical average. And so anytime we need to make an adjustment of yield, you shouldn't get too far away from trend being 178.5 bushels an acre. We at AgResource today believe that corn yields about 179, give or take a bushel as we look at it today. Here's a graphic. Has way too many numbers, but I want you to focus on that yield number at 179.5. That's what our field surveys have showed us, at least through today. And then if you go down, look at the ending stock, still just below 3 billion bushels. So I believe whatever rally we get in this corn market will likely be completed by either this week or no later than the middle of September when that next USDA crop report comes out. We still have an abundance of supply. And if you were asking me, Dan, where do you think lows will be at harvest? I still think we can fall back and test that $3.20 level. So don't get bullish and chase this market as a feed user today. Step back and allow the market to come to you probably during the months of October and November. Lastly, as a feeder, and kind of we talked about the cattle market, we're now talking a little bit about the corn market. As a feeder, if you look at the price of corn, we're pretty much caught up in this viewpoint that corn is really a 3 to 365 kind of marketplace in the early 2021. So as you're all talking about your formulations and your margins, I would be using a corn price of around, excluding basis, maybe Chicago, of 325 to 335. I think those numbers will catch you. Of course, you need to add or subtract your basis for cash markets, but I think as you step back from the corn market, that's pretty much as we see it. So as I look at the world markets, and I kind of to summarize here today, I kind of think that as we go through things, we really need to be looking at the amount of debt that's being enabled by the governments around the world. We need to look at the political winds that are blowing at the November election and what will happen in terms of US farmers getting diminished aid getting forward. And then I think we need to be what I call really managers of margin, understanding where feeding margins and planting margins are for crops forthcoming. Our friends in South America are going to be planting fence row to fence row based on their real being at 5.6 and looking at margins that are 50% over variable costs on corn and soybeans. So the world probably has an abundance of grain. It will be meats that I still believe will have an opportunity to service and be more robust going forward. thank you again for sharing this time. I wanted to stay on task here, Kara. If we could open it up to a few questions, maybe we can answer that in the next few minutes that we have available.
Absolutely. Thank you, Dan. And we do certainly have some time allocated for questions. If you are tuning in and have not yet submitted your questions in the Q&A box, please feel free to go ahead and do that. And we'll likely have time to go ahead and pick it up. I'll kick things off a little bit. Dan, are you surprised that the Chinese beef trade has not picked up any faster than it has? That's something you referenced a little bit.
I am, Kara, but if I go back and I look at Chinese history of adhering to trade agreements, their history is not very good. You know, when they joined the WTO in 2001 and they promised to buy 16.8 million metric tons of corn and wheat, they basically underperformed on that promise to the degree of about 40%. So I still believe that China buys what China needs. Today, China has food inflation. They have needs for corn with their price domestically above $8 a bushel. And so I believe that there is a need that China will, do I think China will buy all $36.5 billion under phase one? No, and I'm really concerned whether or not there'll be a second leg of the phase one that would start in January. I believe this administration, we don't know what the Biden administration should be elected will do, but there's some real adversity from the Trump administration to China politically. The only thing that they've been able to hold together is this trade agreement, and I'm not sure how long that will happen.
Sure. What is the general feeling in Chicago around how results of the presidential election either way could potentially impact the markets across the board?
Well, we still don't know specifically in the Biden camp in terms, they did release a big 500-page paper on ag policy, but it's hard to discern what their real MO would be going forward. I think we all understand that Trump's would be on trade and trying to, of course, nationalize the United States. I believe beyond that, it's a little difficult to say too much. There does seem to be in Chicago with the riots that are affecting our city and other things that there's some anxiety here. There's some real pent-up angst. I believe a lot of it's related to the disparity in income that may be in reflection of COVID times, and the wealthy are getting wealthy on their 401ks as stock markets reach new highs, while maybe the less fortunate are not doing as well. So there seems to be that in the background, but as I go downtown, and I try to go down there once every week or so, it's still not back to normal. Everything's boarded up. It's just a shame to see Chicago as it is, and I think it'll take a while to come back. And with that, it makes this presidential election very difficult to forecast in terms of policy or what each administration will be doing.
Sure. And Dan, you spent quite a bit of time talking about demand drivers and talking about how, you know, export markets obviously create a lot of opportunities for those new demand drivers, but certainly, as you referenced, come with their own fair share of risk. What are some of the greatest opportunities you see for those of us in the beef industry to create some new demand drivers that may not necessarily be hinged to an export market?
Yeah, it's always good to talk about demand drivers, because at the end of the day, if you look at yearly charts going back to maybe the Civil War, it's those demand drivers that give the opportunity to markets. And it usually starts with the grain markets, where a new demand driver can come forward, or a heightened political concern in terms of world wars or something like that. Now, none of us want a world war, but I believe there is things that technology could do to help us build demand drivers. I use the example, Kara, where, you know, if I look back in the last 10 years, there's been $87 billion of money spent looking for technology for farmers to help produce more beef, more pork, more grain. Nobody's really spending a lot of money to help consumers consume more, whether that through bioplastics, that may be something that biodegrades in a landfill, or maybe finding new ways to utilize beef as a protein source, or something in the dairy industry the same way. So, you know, I would really like to get agriculture behind a platform that we think about not only spending on ways to help us farmers produce more, but help consumers consume more, because at the end of the day, that will be the key to terms of our profitability. And so one of the directives, of course, is going to be a weaker currency, but that's not a lasting demand driver. We really need to think about technology that will help us as consumers understand the health benefits and the risks that are associated with the food products we consume. And I believe things like beef, will come out on top in those kind of arguments.
Very good. Got a few more questions coming in here. Any specific projections on feeder calf prices?
Well, as the corn market's gone up here, we've seen the feeder fat spread start to come in. We believe that like fat cattle, the feeder cattle probably have some downside. A lot of this will depend upon grass availability as we head into the fourth quarter. Let's be hopeful that some of these hurricanes do produce at least some moisture across the plains. Assuming that grass level is good, I think that feeder market will still stay up in that, lower to mid 140 range, and we can start to see prices that are good for cow-calfmen. So my view anyway is that the feeder fat spread is getting close to some kind of high here. I believe that feeders will retreat along with fats, but not to the same degree. Again, the key ingredients here being the price of feed and grass availability heading into the fourth quarter.
Can you comment on current harvest cattle weights and their impact on the market?
Well, as we look at harvest weights, they've been increasing rather dramatically lately. If you look at the latest data, we're up 22 or 23 pounds relative to last year, but grades are still holding relatively high. I believe that, the market, at least lately, has been very accepting of these higher weights. I believe that going forward, we'll see more cattlemen look towards higher weight gains based on their experience with animals genetically that have just gone through this period of having diminished packer kill capacity. And so from my perspective, this has kind of been a watershed year. I think we've all learned that we can put on some extra poundage without seeing big discounts, and a lot of those cattle will still grade relatively well. So in my mind, feeding the heavier weights is going to be a theme that will happen as we look towards the future.
And we've got one last question here. I know in the past you've talked quite a bit about the ethanol industry and the direct correlation that industry plays with the cattle feeding world. What is your outlook for the ethanol industry in the next 2 years?
I wish I could tell you it was relatively better. Unfortunately, because of this administration still putting small refinery waivers out there, and it doesn't look like that's going to change until sometime after the election, ethanol is still, as I've been saying in the last couple of years, a mature industry. In other words, we're looking at having very little growth going forward. Here today, we're looking at Americans that are driving at around 9% less than they did last year. That's probably because people like me and our firm, which we're not driving downtown, we're not driving to this cattle seminar, which may be held somewhere in the plains. And so all of these things need to come back to normality before ethanol demand starts to grow. What I'm really surprised on, however, is that our friends in China have not been buyers of U.S. ethanol or U.S. distillers grains. I look at distillers grains today and being cheaper than the price of corn loaded into China. It's really like the Chinese want it to look like they're being environmentally friendly. They should be buying DGGs and ethanol and bringing that into their country. So far, that hasn't happened. In fact, China still has a duty on U.S. Imports of DGGs. So that's a anti-dumping duty. So, I'm not bullish of the ethanol industry today. I think we're mature. We're going sideways. Unfortunately, Americans need to drive more miles. We're going to see the ethanol industry get back to health again. And it's probably going to take a new administration for that maybe to happen.
Very good. Well, Dan, thank you so much. As always, very insightful, very useful information. We certainly appreciate your time today.
Well, everyone should please stay safe. I look forward to seeing you in person next year. And Kara, thank you for the opportunity to reach out to everyone in this homestead environment. I hope you've all enjoyed the discussion and the talk. Thank you.